Welcome to the Millionaire Next Door podcast with Robert Curtis, CFP, accredited investment fiduciary from Signature Estate and Investment Advisors. In this podcast, we help successful wealth accumulators like you looking to transition to a work-optional lifestyle by helping you build strategies for growing and maintaining your wealth. Robert draws from years of experience and fiduciary responsibility and interviews guest experts to help you build reliable strategies to grow and maintain your wealth. Now, on to the show.
Hello, everyone. Welcome to the Millionaire Next Door podcast. So pleased you're joining us today and hope you're getting good value out of these discussions. We're really here to educate folks, and a lot of topics going on with financial markets, with wealth management, with global situations these days. We're recording this. It is April 6th, day after Easter, 2026. I'm joined today by a repeat guest. It's Mark Gatto, and Mark was featured on episode 76 back in June of 2025. Mark, welcome back. How are you?
It's great to be back, Robert. Thank you for having me. I'm doing well. Thank you.
Terrific. Thank you so much. Mark is with CION. I'll let him introduce himself again, but we had covered private debt in a prior discussion, which actually has been historically an excellent area. We covered that within the space of alts and the low correlation and where it fits in with the portfolio. It's certainly been in the news a lot, and people have seen it. And there are some concerns, and we continue to explain that situation and walk folks through that. But do you want to dive right into it? Tell me what you're seeing on your end and your thoughts. Yeah.
Yes, it's a topic that's front and center right now. We're seeing a lot of attention on private credit, which I think on the one hand is a good thing. It's a meaningful asset class. It's an important asset class, especially when you think about building out a well-diversified portfolio. It's something that we feel all investors need to have. A lot of the attention has been brought because of certain things that are happening that I believe are not as pervasive as the media would like us to believe. I think first and foremost, you do have this issue around AI and how it could disrupt a lot of software companies. And there are a number of private credit funds that have focused on software, either as a holistic strategy or a meaningful part of their allocation. But I think that the risk or the displacement risk that is being articulated is somewhat overblown. We think there's a lot of benefits AI can bring to these companies and to the market as a whole. And time will tell, what's going to happen. But one of the things I've been mentioning on the road and as I'm doing these types of conversations is that we thought things in the past were going to completely upend the market, whether it was COVID or some other market technical. And what we've seen is that the companies that we invest in, a lot of these U.S. middle market, upper middle market companies, they're very resilient. They have very good management teams. They know how to hunker down and they know how to weather the storm. And I think you're going to see a lot of that. There's been nothing that dramatic, and certainly in our portfolio, and I think a lot of other managers' portfolios that would indicate there is some sort of imminent concern that's going to happen. Now, will there be some winners and losers? Of course, right? There's going to be some winners and losers in this whole AI game. We feel that if you're invested in a high quality manager that did a really good job of underwriting initially, has the ability to work through problem names, is invested in companies that are supported by big, large private equity funds that are well funded, we think that whatever issues do present themselves are manageable for sure. So that's one side of the concern. The other side is something that I think is a little more complex, and I think a lot of investors don't understand. It's regarding structure and how are these private credit instruments being held, what type of vehicle they're in. And we've seen a lot of private credit funds structure themselves as BDCs, which was a prevalent way of investing in private credit. It's still a good way. But what's happening is that people are starting to maybe understand more fully how these businesses work. And they're all set up in relatively the same way. They are there to provide some form of limited liquidity, but not unlimited liquidity. It wasn't built that way. And funds are getting requests in excess of the typical 5% per quarter of the net asset value. So you're seeing redemption requests exceed that number, which means that the entire amount that has been requested will not be tendered or redeemed. And I think there's a misperception around that where people hear that redemptions were 10% and they believe, and they were gated at 5% or gated at 8% or whatever the number is. Gating is like just a terrible word to use because it's not a gate. It's how these funds were structured. But I think the perception is that people didn't get 90% of their money. And that's not what happened, right? They got most of their money, or maybe they got 50% of their money, but they still got access to their capital. And that's the most important thing, is that these vehicles still allow access to capital. Now, there's nuance there, right? If you look at a traditional alternative investment, a drawdown fund, private fund model, a manager could just completely close off the option to get liquidity, right? BDCs, although contractually they offer this type of liquidity, they too can turn it off. The fund structure that we use, the interval fund, we cannot turn it off. We have limitations at 5%, but we can't turn it off. By regulations, we have to offer that 5%. And we think that's a big distinction between BDCs and some other closed-end funds that are offering liquidity but don't have the obligation to provide it in different markets. A lot to unpack there, but effectively, our opinion is that these funds are working the way they should be. The limitation is there for a reason. Managers and investors don't want their managers to be forced sellers in markets that maybe aren't as advantageous. What we've seen in our funds is that performance has been really strong. Fortunately for us, last quarter, we were under the limit. Our window closes end of this week for this quarter, and we'll see how that looks. But again, I think if you, and we can maybe talk about this further, but if you really start to focus on what are these funds doing, what type of assets are they putting into it, how is the manager investing that capital, these are the things that I think advisors and their clients really need to understand, because every BDC, every interval fund, every credit strategy is not the same. And that's really where the rubber meets the road, is what is being done in these vehicles. And are the managers in a position to manage through these sort of periods of volatility? And that's what separates, I think, the good funds from the maybe more questionable ones.
Yeah, no, that's very fair. It's so interesting. I think a lot of the driver of this is AI, right? And it's just making people, there's a lot of anxiety around it. What is the promise? I've commented for at least 2 years now, we went from a period where these hyperscalers were making massive profits, massive cash flow, Apple, Microsoft, et cetera. Now they're putting almost all their cash flow into AI development. Oracle had an announcement of laying off 30,000 people because they want the funds for infrastructure development. And paradoxically, now in the private credit space, a big initial catalyst was concern that maybe a lot of these undifferentiated or funds that might not have been as strong went heavy on the AI or software space. The model is, so the markets have reacted with this dramatic pullback in AI and even like cybersecurity, things like that. It seems really dramatic, as if AI is just going to magically replace, and that software is just going to replace all these systems that have been around. But I'm sure some funds were too loaded up in the space, and that's having issues. But on another level, what's concerning to me, everything you mentioned has been well articulated in the 5%. We just haven't seen these kind of redemptions. But the press has been very ceaseless in just attacking it. And it's really making a lot of people anxious or nervous, and they think the whole thing's going to collapse. Even Jamie Dimon came on, I think, over the weekend and said it's a $1.8 trillion market and it's really fine. But I think some folks flowed into it that didn't fully understand it. So maybe some of that shakeout is healthy in the long run if they just don't fully get it to go through. They had given these retail investors access to spaces that were normally institutional, things like the Gates Foundation and whatnot. So we'll see. But I wonder if you have a comment around that or a thought, or just curious. That's my take on it so far. But we're watching it very closely because sometimes things develop. But they're painting it like even during the global financial crisis, these things held up absolutely beautifully.
Yeah.
But I'll turn it back
Listen,
to
I
you for a
think
moment.
the media's job today is to stir up controversy, right? They need to get eyeballs on their information, so to speak. So they're going to try to drum up, I think, some sort of controversy that gets people talking and interested. And our opinion is that the attention to this is misplaced. It's overblown. It's like any other market where you're going to have fundamentally strong businesses and other businesses that maybe aren't so strong. And that's at the portfolio level, but that's at the fund and investment level. And one of the things that we've preached from day one is diversification, right? We don't believe that strongly in high conviction vehicles for our investors, right? Because we think high conviction vehicles, they can outperform in certain markets, but they are going to severely underperform in less favorable markets. And that's what you're seeing, I think, for some funds that went very aggressive into software. And people have concerns, rightfully. Now, will those concerns come to fruition? Will they be as extreme as people are talking about today? I can't say for sure because I do think that there's going to be some benefits that these companies will extract from AI. But again, being highly concentrated in any one sector, any one geography, to us isn't the way to approach this business. We think diversification is the way to play it. Our fund is called the CION Ares Diversified Credit Fund, and we intentionally did that. We wanted to make sure that our vehicle could perform in all different market environments. And by doing so, we've been investing in the bond market, high yield market, bank loan market, as well as the private debt sectors, right? Both here in the United States and elsewhere in Europe and the broader global market. So we really have a structure that allows us to be flexible and dynamic and move capital to where the best relative value is. And if you look at just fundamental underwriting and fundamental reviews, and Jamie Dimon was talking about this, I think today, and he's been all over the place with this. I respect him greatly, but he's been all over the place. But if you're investing in highly levered companies, right, and the market takes a turn and the economy slows down, there are going to be problems. So that's just fundamental. We all know that in this business. This is not peculiar to private credit funds, right? This is about good underwriting. It's about an investment manager that knows how to source opportunities, can be very selective in that process. And these are the things that need to be focused on. One of the things also that people aren't understanding that well and not really looking at, and something we've been talking about for many years now, is how is the capital being invested? Are you investing directly into security, or are you allocating capital to another manager who's putting that money to work, and your access to that capital is constrained by the contract that you've entered into with that other manager? We invest directly into securities. CION Ares Diversified Credit. We source the opportunity ourselves. We underwrite the opportunity ourselves, and we invest directly into that security, meaning that we have direct access to information, we have direct access to our investment, and we have a seat at the table if things go wrong. Very important. Same thing for our infrastructure fund, highly diversified across various different asset classes, among various different sponsors, investing directly into security. It makes a world of a difference, especially when you talk about the concerns that we're hearing about today versus someone who's an allocator of capital to another manager, right? And you think you have liquidity because the assets that manager is investing in has some form of liquidity, but your contract with that manager, so you can't redeem your capital for 3 years, right? And people aren't really understanding that. They're assuming that because Fund A invests in private credit and Fund B invests in private credit, that they're doing it the same way. And that's not the case. And when times are good, everybody looks fantastic and everybody's doing a wonderful job. But when times get more difficult and the markets aren't as favorable, that's when you get to see the warts and you see the chinks in the armor and things like that. And I think that's what you're seeing today. Some of the funds that approached it in a certain way are going to have a little tougher time in this market versus funds that, in my opinion, do it the right way, right? Source their deals, have access to deal flow that allows them to be very selective, good underwriting teams that do all the work initially, and again, can control their destiny because they're directly investing in these securities. They have a seat at the table. They can renegotiate terms if problems happen. So it's nuanced, but it's important. Really understanding what's under the hood and how it's being done is critical to investing. And because we're coming into a market that maybe isn't as benign as we've seen in the past, these things are going to matter.
Those are super important points. And just to your point about due diligence, my own way, I'm thinking about just your home cooking, what you make in the home. You're in control. You're watching the expiration dates. You're cooking it. You're washing your hands. All those ingredients. If some doesn't, but so you, and I don't think I've ever got nil off that. I'm not throwing a restaurant under the bus, but you're outsourcing that. You really don't know, even in high quality places. Somebody could not wash their hands and you get a.
It's funny. I talk about that all the time. I'm very health conscious and try to eat very healthy. And people think because they go to a restaurant and order a piece of salmon, they're eating healthy. And it's not true. You don't know what type of salmon that is. Is it wild caught? Is it farm raised? Are they cooking it in seed oil?
100%.
Are they cooking it in olive oil? But it tastes good. It tastes good and it all tastes the same to you and me. But is it really good for you? And I think that's a great analogy.
Yeah.
If you're letting somebody else doing your cooking, you don't know what the ingredients are. You don't know how they're making it. And you don't know how it's going to make you feel down the road. So I really like that, Robert.
100%. Yeah. Wild caught Alaskan. I've got olive oil there. I watched that. You don't know what they're putting Wesson oil or some seed. They're going to use. I just think it's a good analogy and it matters a lot. And you brought up last time, which was really interesting to me, a couple of examples. You've stressed diversification, low correlation, private companies, the importance of low debt. That's a constant throughout time. Buffett's talked about that. We know that.
Right.
If you're pushing the debt, you are really running on high speed and things can come up. But you mentioned a few things like Rawlings was something in there, the glove manufacturer. You mentioned things like the Miami Dolphins and sports teams. And I think one of the I don't know if soccer, Manchester United or one of them you mentioned. That's really a whole different stream of businesses and adds diversification. And people may lose sight of that. It's interesting that I live in Southern California. I just got my little window to go in and purchase Olympic tickets, LA 28, over the weekend. And so I looked through 38 pages and it was interesting what's available, what isn't available. Some of the stuff, it was a real window into what sports pricing was because I saw some skateboarding in the park. I thought that would be interesting. $600. I'm like, what skateboarder has? I couldn't get a deal on the men's tennis. It's actually cheaper to go to the BNP Paribas. I had a friend who got on an earlier window and it's $100. So we did a mountain biking thing, women's $28. We did get some beach volleyball, but yeah, it's a very dynamic thing how sports marketing is priced. And so baking things like that in through easy access and with the underwriting that knows how to source those deals, that is huge. Let me pivot to another, again, AI. It's such a dynamic factor in our economy and our lives. I'm constantly looking for ways to integrate it into my practice to save time. You have to, or you'll be displaced. I talk to my adult children about it. There's various levels of skepticism, of it taking jobs, of distrust for it. It's just such a dynamic factor with all these dollars going in. I saw something in the local paper here. We have a local utility, and they're real concerned about these data centers locating. They just want to be very careful because if you look at the amount of energy they're sucking up, that could displace an entire city's worth of energy, and the residents who it's really there for don't have any energy. So they want to be mindful and the water needs. But talk to me, and this can integrate with private credit, but software, and I'm wildly excited about infrastructure. We've covered it extensively on the podcast in the past with folks from Stepstone, folks from Cantor Fitzgerald, all of which, even Aries we've talked to, and they can have different, there's a lot of dollars going into it. The world's marching ahead. These things are going to be spent even on a basic level of sewers, pipes, whatnot. We've just underspent for years.
Sure.
It needs to happen, the data. So long intro, but tell me a little bit about your thoughts and maybe how people position and within portfolios. And I'd love to hear your thoughts around that.
Well, infrastructure as an asset class is a huge opportunity. It's something that globally has been underinvested in. It's a multi-trillion-dollar opportunity over the next 5 to 10 years. And we see it as a great place for investors to capitalize on what's going on in the marketplace. You mentioned AI and data centers, and that's been, again, front and center. The media has been focusing on it, but infrastructure is a very broad asset class, and it includes everything from what I'll call traditional infrastructure, toll roads and bridges and things of that nature, to telecom, cell towers, airport terminals, data centers, like you said, cold storage. There's adjacencies that will include like social networking and things of that nature. So there's just so much to invest in within an infrastructure strategy. And we really like the asset class because it allows us to be diversified. As we said before, we're not, our infrastructure fund is a diversified infrastructure fund. We are not focusing on any one category. I think maybe one or two of the people you mentioned before, they were focusing or initially wanted to focus on clean energy, which is not the topic du jour with the current administration. So whereby clean energy was very, very interesting and was a sort of hot topic, say 3, 4, 5 years ago. If you were investing in a clean energy fund and you find yourself sitting here today, you're like, wow, what are the prospects of that fund performing well? And it's probably pretty low. So that's why we don't advocate that approach. Our approach is to say, okay, can we partner with a manager that has the capabilities to access an abundance of deal flow across all those various asset classes, whether it's traditional infrastructure, whether it's the more modern versions of infrastructure, the cold storage, the data centers, and things of that nature. Can it do both clean energy and traditional fossil fuels, right? Important, because we want to be as flexible and dynamic as we can as we invest over the long term. And these products, our funds, are structured as interval funds. They're continuous offerings. We raise capital on a daily basis, and we'll continue to raise capital in an evergreen style. So how can we construct a strategy that will stand the test of time and be able to perform in cyclical and volatile markets? And you do that through having a diversification mandate. You do that through having a partner, and our partner on this fund is Grosvenor Capital Management, and they are the preeminent infrastructure managers. And they have relationships and ability to source transactions across the entire spectrum of infrastructure through relationships with various sponsors. And it really gives us the ability to fully take advantage of what's happening. And we see it as a great complement to the private debt, private credit, or in our case, diversified credit story, where credit is a high cash flow, income oriented investment strategy, where infrastructure, at least the way we do it, where we're investing in the equity of these infrastructure investment opportunities, it's a growth story where we're able to capitalize on the growth of these investments. We're providing investors with a hedge against inflation, because if inflation is going to go up, the value of these assets will go up. So there's a lot of virtues to investing in both credit and infrastructure. And if you can do it with a firm that has two strong managers, two of the best managers in those respective strategies, and a firm that's doing it in a thoughtful way that's appropriate for the individual investor, I think it serves everybody well in helping to build out, again, that diversified portfolio. So you want to have diversification in the funds that you invest in, I believe. And then obviously you want to have diversification in your own portfolio. And to really get that diversification, you need to incorporate these types of private market investment opportunities.
Yeah, that is so well said. I've been doing this 28 years now. So you hear diversification, but at different layers. That's been a pretty common theme
Right.
throughout this podcast. It really is essential, and exposure to things that you previously didn't have exposure to, private companies, where something like 90% of the companies making over $100 million in the US are private, and public doesn't have that exposure. And in different streams, you talk about infrastructure, even an airport. So post COVID, that was pretty dramatic on them, COVID, but then they've made up all those revenues, or they just pass on those costs. You're not going to build another London Heathrow, right? Or JFK. It's just not going to happen. It's a monopoly, and they can pass those costs along. Talk about inflation now, right? With the war in Iran, oil prices, all these things that are likely to happen. You want inflation protection. And I even look at the dynamic, the green energy. We didn't go too heavily into that, or try to be very sensible and watch what was going on. But you see how certainly the US autos have completely retraced from that, right?
Yep.
Honda got out, if not mistaken, and took losses of billions of dollars. And some of they're just completely reversing. So it is interesting. And then the oil and energy that seemed just so out of favor for so long, now that's all coming back, with the U.S. being the largest producer in the world and the increased independence. So it's really an interesting time, and it's important to have diversification, because the way the markets were going, everything was going into 7 stocks that were publicly held, and that overconcentration, there had to be some flow out. So now you have all these the breadth, things are broadening out, but a lot of those will benefit from AI as well. And having exposure to private companies, more companies want to be private than public. Hey, real quickly, there's talk of some of these major private companies going public, right? SpaceX and others.
Sure.
If you have that in your fund, then they go public. What is that? You've just made a greater return on your...
Yeah,
How's
so
that work?
we don't have those unicorn companies in this portfolio, but
Okay.
there are instances where a private infrastructure company that we've invested in goes public, and there are cases of that, and we get extremely strong returns, right? Multiple type returns, which is exactly what we're shooting for. The downside to that is it imposes a little bit of volatility in the NAV of the fund, because now you have some public securities. But what we do is we endeavor to wean our way away from those investments by selling off after lockup periods and things of that nature. But it's something that could happen. It's an exit strategy that gets incorporated into the model, whether the fund or the investments that we make in infrastructure, they get traded to another private entity or they go public. That's a good thing for us. And then we just manage the process. Like I said, there'll be some more volatility in the fund when we do exit a position into a public entity, but the returns greatly outweigh the impact of that volatility over a short period.
That's great. Really appreciate your time here. This has been terrific. And again, diversification, managers that really understand it, other opportunities that you might not have access to. It's been a real evolution to see retail investors get this kind of access and invest more pensions and endowments where it makes sense, with the guidance of a professional advisor or team that understands how this works together, or maybe entry level into it to start to build those up to levels that really will benefit them, especially in a market pullback. Your stuff is even on the private credit, or how much is retail versus institutional these days?
In terms
Just
of the
roughly.
capital?
Yeah, I guess so. Yeah. How much of an inflow,
Uh,
or is it still heavily much more institutional?
No, our funds are heavily individual investor. That's CION Investments. Our allegiance, our mandate is to provide alternative investment solutions to individual investors. We don't have large institutional investor relationships. And I think that's why we're a tremendous partner to the advisor community and their clients. Everything we do has your best interest in mind, because if we don't perform on your behalf, we have nowhere to turn.
Okay.
So I think that gives you an indication of where we're coming from and how we approach the marketplace. We like to think that we do so in a very thoughtful way, knowing that we are completely dependent on the relationship with you and your clients, and that's a big distinction. But yeah, so you're going to see more and more institutional capital in these funds. Like, we do have larger institutions that are now investing because the structures are strong and they appreciate the ability to have that liquidity there for them when they need it. So I think the reasons why we promote and advocate for these funds to individuals is the same reason why larger institutions are becoming much more attracted to it, where historically they would invest in very illiquid products. They're starting to see the benefits of maybe giving up, I would say, nominal return in exchange for the ability to get some liquidity. So I think it just substantiates what we're doing. But CION, as an organization, we are wholeheartedly focused on the individual investor, and the advisor community.
Well, appreciate it. I think it's great. And the interval fund structure compared to the way it was with the tax simplification, really every 90-day type access. That's a huge development without the lockups that you had before.
Absolutely.
All the K1s. I want to thank you for being here. I don't know if you have any quick closing comments, but otherwise we'll let folks move along. But yeah.
I would say thank you for having me again. I really appreciate it. But I think you mentioned a couple of things before about manager selection is critically important. Understanding, again, what you're getting yourself into. All of these funds are not created equal. They don't approach the markets the same way. And the structure within the structure is extremely important. And ultimately, diversification is something that everyone needs to really focus on. And there's, like I said, different layers of that's diversification within your own portfolio, but also diversification within those investments that you're making. Just be aware, I think, of those three things. Know that a lot of the attention on this market is because it's meaningful, because it's working, and because investors, especially individual investors, are having success. And that's the most important thing, that individual investors now have the same opportunity to capitalize in the same way that large institutions and ultra high net worth people have been doing for years. And that's what we're trying to accomplish at CION, is to give you and your clients a platform to build wealth over the long term.
Oh, great. Again, really appreciate it, Mark. This is such a great discussion. Thanks for being here. And thanks to our listeners for listening. If this raised any questions for you, please let me know. I do think it's very exciting to give this kind of access, but we want people to understand what that means and how they think. And it's interesting times for sure with AI, and we're going to be living through that for a long time and its implications. But we're here to help you cut through that noise. Mark referenced the media's job is to just drive a lot of worry and anxiety and get you to tune in. I think that's probably a constant, right? It's not going away. So we're here to help with that. Thank you so much for listening, and Mark for guesting. And please, if you enjoyed this, please like it, share it. Let us know if you have questions. And we'll see you next time on The Millionaire Next Door with Robert Curtis. Thank you for being here.
Thank you for listening to the Millionaire Next Door podcast. Click the subscribe button below to be notified when new episodes become available. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of Signature Estate and Investment Advisors or Royal Alliance Associates Incorporated, member FINRA SIPC. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning.
All investing involves risk. Past performance does not indicate future results. Specific products discussed are not suitable for all investors.